Well, hey, everyone. Hope you're having a great day out there. It's yours truly, Warren Howe. Today, we're going to take a look at Dropbox. But before that, you guys know the drill. Show a brother some love. Smash that like button, smash that heart button, comment, hashtag live if you're watching this live so that I know you're here. Or say hello, just to let me know if that you're here. um Exciting stuff. I know some of you are also Dropbox holders. So exciting stuff. We'll be going through Q4 highlights. We'll be looking at their 10K, their recently updated 10K. We'll make sense of the numbers to work out the valuation. And if you're watching this on replay, appreciate it if you click hashtag replay, guys. So you guys are awesome. I want to cover a few things as well, right? So just give me a few minutes. We can talk about Russia and Ukraine for a little bit. And this is a intense situation, right? So before jumping into Q4, I like to talk about live updates. I like to talk about what's happening in the market. Are you guys hedged well? Let me know. Let me know in the comments, right? Are you guys hedged well? What are you doing to hedge yourself? Are you protecting your portfolio from a huge drawdown? What are you guys doing? So I want to know, if hopefully you guys sort of update me in the situation. I'll be happy to be chatting more about it. Also, what is your long-term trajectory? Are the valuations on your, the whole market is actually having a huge re-rating, right? So obviously all stocks are going down, but what are you intending to hedge? What is your plan to hedge? Like, we have strategies to hedge. For example, the best inflation-proof strategy is to just pile onto your winners, pile onto your longer-term stocks, right? It could be Palantir, it could be Tesla, it could be SoFi, it could be, depending on whatever company that is higher up in the S curve and sort of working there. So yeah, there's a lot of ways to hedge it. Hopefully you guys are cautious. Now let's talk about Russia a little bit before I jump onto, Dropbox. Russia is a problem because the event in Russia is a problem because Russia is I'm not sure if you guys are watching the news, but want to go back in memory lane a little bit. We want to talk about why is Russia actually invading Ukraine, right? So all in all, if I was to summarize in 2 words, it would be power, it would be control, right? Maybe they don't want Ukraine to be so resourceful anymore. They don't want Ukraine to join the NATO, the alliance, right? To be partnering with US and other Western countries because they're going to have another force of their own. So it's sort of like reminiscent of what's happening in China and Taiwan and China and Hong Kong in a way, right? So, Big Daddy, Russia, Putin, he doesn't want them to have too much power. So I'm pretty sure it's out of fear. I'm pretty sure it's out of greed, right? There's a hidden agenda of Putin. But why am I bringing that out is because, first of all, we have to know why, right? Second of all, we have to know sort of what are they intending to do. Is it, gathering resources back? It's basically control. But also, we have to understand why is it such an impact for, why is oil eventually going to go up if they decide to attack, right? Now, that being said, I mean, that's why I'm asking in the first place. In the first question is that what are you guys doing to hedge your portfolios? So if let's say they attack, supply crunch is going to be a huge, like there's going to be a huge supply shortfall for sure. That's other than bombing, right? Other than risk of bombing stations affecting the supply. Russia itself produces globally the third largest global producer, which is 11% of global consumption, right? And 50% of that goes to Europe. Okay. They're also a big natural gas player, right? I mean, it's like a natural gas and metals hub, right? Russia. So what are the potential investments that we can hit? So remember in FATA and in fundamental analysis, technical analysis, we combine both. And even in the public account, which I haven't been really active at the moment, we sort of planning to hedge onto oil, which may be a little too late and maybe priced in, but if after looking at events where they're stationing in borders and stationing, getting ready nuclear weapons and whatnot, that's a problem. So we have to consider the option that they might actually invade, right? Now, I personally think that they won't invade. I personally think that they'll be stupid because, I mean, imagine that is a substantial amount of their GDP, right? Substantial amount, oil, right, for Russia. So if that is if they really do invade and they risk, the country's GDP, wars are expensive, country GDP is definitely affected. Um, they are putting Russia itself at risk, right, and the economy at risk. So knowing that they supply 50% of Europe, imagine all the countries that are don't have that are dependent on oil, right? So this will be a whole ripple effect that for France, Korea, all these sort of countries, this will have a ripple effect moving forward, and eventually they can't keep up to that consumption, so prices will spike. Now analysts have the oil prices spiking to probably 120 if they do invade. I personally think there'll be more. And the fact is, we need to understand before we make these sort of thematic trades is that whether or not the oil prices, the stock price running up, because we see, stocks like Devon, ConocoPhillips, these guys actually going up. The question is it priced in, right? The question is it priced in? And I don't personally think so. If let's say they do invade, because they are upstream players, right? So correct me if I'm wrong, you OGs that are in the oil and gas market, all upstream players actually tend to have more margins, right? So if let's say prices are going up, upstream will definitely be the ones that are benefiting from this. I mean, overall, everyone is benefiting, but if you want to be a safer and talk about fundamentals, then upstream players like Conoco and Devon will be um, sort of should be in our watch list, right? So I'm personally going to enter into COP. Don't follow me, just do your own duty. And that's my thought, right? My thought process is that we should be hedging and looking into natural gas, oil and gas, aluminium, right? Metals. So because these will be their prices will spike up for sure. Now, if you guys are investing in the US, which I'm pretty sure a majority of you guys are, we have to know that US is number one, right, in the list, and they are not going to be affected for sure, right? I mean, because they have their own supply, they have their own, they're self-reliant, right? And the shitty thing about this energy sector, like I'm new to this energy sector, right? I'm new to it. I've done my duty. I've been spending hours and hours of research, so that's why I can come up to a conclusion that is good to hedge. But all in all, I'm trying to say that we have to understand the macro and understand why is it safer to be investing in the US or certain markets, right? So the economy ripple effect is definitely going to be affected. Korea, those that are just importing, but America is still all good, right? Now that on the other flip side, that's the benefit of me investing in Malaysian companies, because like PMB Tech, right, silicon metal companies, oil and gas companies like Hibiscus, whatever it is. That's the benefit of having money in different markets, because those hedges have proven to be quite good so far, right, fundamentally and technically. So PMB Tech has been going up 50% year to date since January until today, which is good. Yeah, these are things that we can capitalize on, right? So it's always good to be in the market and knowing what's happening. This is what I mean by the shorter term thematic plays, where we know how can we capitalize on that, knowing what's the situation, what are the events. So that's important, right? Now you don't have to follow me, because some people, especially some of my clients, they are more long-term plays, right? They're 100% long-term, and which is great, right? I do this as my own business. I'm in this full time, so I got the time. But all in all, this is what we want to be looking at, right? We need to be looking at what's happening in the world. Even a 10% trade is practically free, because all it takes is hard work and just studying. So yeah, hopefully you guys are hedged well. Let me know in the chats if you guys are what are you guys looking at, and we'll get to it. So let's talk about Dropbox, right? Sorry for that. I took 10 minutes on that. That's about Dropbox, and looking at the SEC filings, we can see 10K. They just filed it. Now, I'm not, you know what? I did a highlight. In fact, I did a YouTube video. I have my own YouTube video, and I literally did a 29-minute video on this because I went through the qualitatives. Be sure to check out the YouTube video that's going to be uploaded here. But so here are the highlights, okay? And later on, I'll jump into the, the 10K. So the highlights is that it's crazy because their free cash flow for Dropbox has been growing 40%, right? Free cash flow grew 40% full year, and which puts them now at like 708 million, right? So their longer term goal is to be 1 billion free cash flow positive, and by 2024. So that's technically they have 2 more years, right? 3 more years in a way, right? Full year 2022, full year 2023, full year 2024. So there's plenty of time. And as we know, Dropbox is a company that is very slow. It's a turtle grower, but it's slow and steady, right? Slow and steady wins the race. So free cash flow going down 40%. These are the sort of qualitative highlights in a way. 600,000 paid teams, up 100,000. Nearly 50% of basic new signups come from mobile. So as I remember in Q3, and I think I did a live on this before, is that they're targeting new new signups are actually from mobile, and they want to make that seamless process. They've been venturing, they've been sort of pushing in more marketing into that, and they found out that if they give sort of free longer free periods just to educate on the new products, right, from acquisition, from HelloSign, DocSend, and the acquisitions, they saw better results. And this was highlighted in Q3 or Q2 before, as I recall. So nearly 50% of basic new signups come from mobile, which is a good sign. And they continue to evolve FSS, file sync and share business. These are the 3 pillars. Expanding workflows, serve creators, right? So if we understand Dropbox, we'll know that their demographics is actually small business owners, freelancers, gig economy, creative designers, right? And basically just creatives overall, right? So they see rich media, they see content, and that's where they launched the beta mode of Dropbox Shop, Dropbox Replay, and Dropbox Capture, right? Because they want to encourage more rich media, more videos shared. So think about it. We are sitting on a company that is a beneficiary of digitization 3.0, right? Digitization 3.0, where things that the internet's already here and everything's happening so quick. What's going to happen in 3 years time, where files are getting bigger, more videos, people are going to miss each other more, and families can't meet each other because of COVID. I don't know, whatever it is, right? They'll store in more and more sort of their own personal content. Companies will have more content and workflows, creative designers and more ads, whatever it is. Like, the files are getting bigger. It's not going to get smaller, seriously. And that's where they have a fit, because they are generating revenues of data size, right? Not only that, they're also generating revenues of workflows and how things are actually seamlessly shared. That's where DocSend comes in. So in my opinion, it's slow. It's very slow. It's not like a growth 70% like Tesla, but it's like a slow and steady sort of stock, which I personally like as well to hedge, because from the all-time highs, I mean, for a tech stock, they're actually not doing not too bad, right? They're just down like 25%. So I mean, and the questions are that we need to ask ourselves is that how many SaaS companies out there are profitable, right? So Dropbox is a SaaS company. They're profitable already. We should be looking at the financials. How many? Like, there's not many. So these are things to consider. And their operational leverage is crazy, right? The operational leverage is crazy. So PDF files shared on Dropbox grew 40% and videos grew 25%. Promoting rich media. This is what I'm talking about. This is the testament that this will just grow and grow and grow, and in turn, growing the whole bringing more profits, right? So, and helping creative professionals, Dropbox helps Sundance Film Festival to seamlessly go viral. So they're proud of that. And Drew Houston actually mentioned that in the call. So I went through I went through the transcript actually, and I found all these things, right? So financials, Q4 beat guidance range and grew 12% year over year at 565 mil. So basically, they had guidance. Yeah, every time they have guidance is like really low. That's their tactic in a way. That's their style. They literally beat guidance every quarter. So it's better to overperform rather than underperform what you promised, right? So that's that. The gross margin at 81%, which grew 1%. Okay, that's good, right? That's above industry standard. Industry standard is probably like 78 to 79% for SaaS model companies. So yeah, S&M decreased from 20% of revenue in 2020 to 17% operating leverage. G&A, right, decreased from 9% of revenue in 2020 to 8%, again, operating leverage. Operating margin up 9%. Guys, this is insane. Operating margin. So when we invest in companies, we want to, obviously look at expanding margins, better net profits, better profits overall, pegging a decent PE. And we have companies that are expanding margins at these times right now is really good sign, right? Operating margin up 9% to 30%. So if let's say, corporate tax is like 21% right now, correct me if I'm wrong, we can give a very decent net income margin that is close to Facebook levels, right? Close to Facebook levels. Facebook's like 30 plus, but and that's the beauty of a SaaS model, right? Beauty of a SaaS model, as long as you control your operating expenses, your gross margin is good, you can eventually have good operating margins. Yep. So free cash flow is at 708 million, which is 33% of revenue. That's insane. These are some numbers to actually consider, and consider Dropbox as a hedge if you want to, right? So net income for Q is at 160 mil. Now, I did this summary before looking at the 10K. We can actually look at the 10K later. Tax benefit of 38 mil, and 3Q net income is at 211. So that puts their net income to be at 371 in full year 2021, right? So based on the 10K, it's actually 330. Yeah. So that is not that as attractive because right now their PEs is at 25. Yep. But that being said, though, when we invest, we also want to look at forward PE, right? If we would, the beauty about Dropbox right now is that we can clearly see their. Let me just, I'll talk about guidance, but let me just, skip through here and there. So this is the 10K, right? The beauty about Dropbox is that we can see them sort of increasing revenues. Cost of revenue is somewhat stagnant. Okay. Therefore, gross profit is actually more. And when we talk about operating leverage, we have to consider the total expenses, which is actually eventually getting less. Now, this is 1.7 because of that impairment, which is not, it's a one-time, is nothing to do with the core business. So let's take that out, and I got my calculator here. 176 minus 398. So it's 1378. Okay, 1.3B which increased a little bit. And we got an impairment here, which is 1.4, right? So 1378 increased to 1.4. Now, if you have bigger sales, which is a growth of 12%, I'm mistaken. Let's see. We have. So we have 2157 minus 1913 divided by 1913. So this is just a 12.7% jump. And we have 1913 minus 1661 divided by 161. So this is a 15% jump. So see, that's the problem. Like when we look at revenue growth, when we look at companies that we want to hedge on and whatnot, I am the growth whore, right? I look at growth and I want, a minimum of 30%, right? But that's not the case. In fact, that's a lot less than what my criteria is. It's just that we have to know the risk and rewards, especially at these times right now, to be hedging on. And I think it's okay. So why is it okay? Because operating leverage is at its best, right? They're already profitable regardless of that 15% jump. So in 2020, not taking out that impairment, they're actually profitable by 148 mil, right? 140 to 148 mil, okay, which is on 2020. Now that doubled up, and this is where shit starts to get real, right? So in every company, we want to look at turnaround. I love turnaround companies. We need to look at how sexy is their growth and projected models and whatnot, obviously. But uh, the journey of this company is getting clear. We have growth companies like SoFi. We have growth companies like Affirm, right? And you run your projection models. We got Dutch Brothers, whatever. But all in all, when we want to sort of get a decent valuation, we have to project, right? It's all about projecting. It's all about estimates, and estimates can go wrong, obviously. But my point is, a company like SoFi, way lower down in the S curve, which is a lot of runway for growth, they whether we like it or not, there are risk factors, right? What if they don't hit guidance? What if they don't make it? They're still spending a lot on sales and marketing. But Dropbox right now is like sort of broken that inflection point and going further up in the S curve. And that's testament because their revenue growth is not as sexy, but they do not have to spend a lot on sales and marketing anymore. And that's where things get interesting, right? So what I'm trying to say is, I'm not trying to encourage you guys to buy Dropbox, but taking this into consideration and knowing that Dropbox is a company that is clear, right? The path is getting clearer. Everything can be projected more predictable. Yep, things are getting more predictable. So that's where we can actually peg a decent growth rate, a decent net income increase. And again, remember the game plan is, right? If we look at the SAM, right, and the SOM, SAM is serviceable attainable market, SOM is the serviceable attainable and obtainable market. But I would like to call it SROM, right? Serviceable realistic obtainable market. So remember, we got that 700 million users, right? Free. Then we have maybe people on trial, which I'm not sure the amount. Maybe it's 10%, maybe it's 20%. I don't know. 20% is like 140 M. And we have the 2% paying users, which is at 16 point, I believe in Q4 was at 7 mil, not mistaken. And this is just 2%. The beauty is that all they need to do is to convert and retain, not having to increase and widen that TAM anymore. They can just focus on this. And how they do that is, acquiring Command E, which is a universal, search indicator. It's pretty cool, but it's not like, wow, right? It's not something big. So all they need to do is just increase that. So imagine if that goes to 3% or 4%, how will that, do in their profitability, right? It'll be crazy. So that's what I have to say. Basically, we have to work out the net income, which is 335. Now, so let's see. The impairment is at 31, so I'm not going to cater that, but they did mention they have a income tax benefit, which is 38 mil. In here it says 36, but okay. So that offsets each other. So if you want to work out the core net income, it would be around 335, right? 335. So we got 335 net income. So let's work out the PEs. Now, the market cap dropped down further, which is 9.2B, right? So 9260 divided by 335. We are sitting on a 28 PE company right now, trailing 12 months, right? So my question is that good? Is that bad? Obviously, there's a huge re-rating. Will Dropbox be expected to drop down further because of this PE? But also we need to look at, we talked about path to profitability, we talked about clearer path, we talked about everything more safer, right? So if I was to decently peg a revenue growth on Dropbox, I would say 10%, right? So 2157, which is the revenue of 2021, you times by 10% extra. They guided 2.3B by 2022. Okay, which I personally think is sandbagging. I personally think that they can definitely make it. So let's put it at 2.37B. Now, their guidance also as well is that they are intending to have 30% operating margins to 32% over the long run. But I think they can achieve 30% because they achieved operating margins of 30% in Q4. Yep. So I personally think that they can actually achieve that. So let's say operating margins at 30%. Um, so let's put it there, 30%. But they're not going to get net income because there's going to be taxes, right? Obviously. So let's say taxes at 21% and sort of interest, we can put it at 22 or 23. So let's do that. Minus 711. We are looking at net income of around 500 to 550 mil. Now, personally, again, I think they can definitely beat that. But if we were to work out forward PE, so it's 547, right? For market cap of 9.2B divided by 547, we are actually looking at a 16, 17 PE company, right? So it's nothing exciting where we can see single digit PEs, but then again, they are a SaaS model. They have growth potential somewhat. So these are things to consider, right? These are things to consider. So let me clear this before. Yeah, so this is what I can make from the 10K. Everything is decreasing. The net income is here. What else do we have? Net income, balance sheet. Let's check out the balance sheets a little bit. So 2021 full year, they have 3 billion in assets. Cash and cash equivalents raised, and their short-term investments actually raised up. As I recall, Q4 is lesser than Q3, but that's okay. And they made acquisitions. They also, I think they are intending to have that sublease, which is good because their staff is working from home. They're not using the space, so they can actually sublease it. Total current assets 1.8B. Operating lease is at 419, not 13 mil right now. Goodwill is not too high. So we got 3B, which is good because it's a raise. Now let's look at current liabilities. Deferred revenue. Okay, so a majority chunk is deferred revenue. I'm not so afraid because that's just it's an obligation to deliver the service, and liabilities are only at 1.1, right? So it's very healthy, not exactly 2-to-1 ratio, but it's still healthy. And remember that convertible senior notes, right? Which is, I'm not mistaken, it's 0 coupon, but I need to check again. That's why we have total liabilities actually more than the total assets. So they raised this to, obviously have acquisitions, to buy back their own shares. They have a buyback share program. So that is good in that way. They want to give shareholders back their returns. Other than that, there does not seem to be, there's a breakdown, right? There's a breakdown of what they spend and what's decreasing. But overall, as what was summed up in the transcript that I read is actually good. Yeah, so that is it for Dropbox at the moment, right? So my sort of so the guidance that they gave was 2.32 to 2.33 2022 guidance. Long-term gross margins. Now, this is why I'm also quite bullish on Dropbox, right? Now, they previously they had from 2020 to 2021, they sort of guided that they will achieve 78 to 80% in gross margins, right? So we love a company that is actually always improving. Oh, there's traction, there's improvement. That's where they raised their gross margin target at 80 to 82%, right? Raising by 2 basis points, right? So that's good because they already achieved that. This is a record. Everything is if you notice, a lot of companies are actually having record revenues, record net income, right? A lot of companies, not all. So, 80 to 82% is actually very decent. It's actually very good, right? So long-term operating margin target at 30 to 32% from 28 to 30%. So again, it's a rise of 2% on operating margins, which is a very good sign. Now, their 1B free cash flow by 2024 is maintained. They have a free cash flow right now of 700 mil. This is going to be easily, they'll definitely raise it again for sure. But that gives them a lot of cash. So, technically 1 divided by 9, that's like, okay, so it's not, no, 9 divided by, so they're sort of 10, below 10 or 9 times free cash flow in terms of a market cap, right? So it's a very strong figure. Most likely beats in revenue guidance. I personally think they'll reach 2.4, which is a 12% higher than 2.158 and a 24% net income. So that will bring them at 576. So 576 divided by current market cap is around 60. We're looking at like a forward P of 16 to 17. Finviz actually has them at 15, but that's that. So the conclusion about Dropbox is, obviously their value play, less volatile in bad times, right? How many SaaS cloud companies are profitable and have good operating leverage? Clarity and path for future is really bright. I mean, it's clear. There's no fog anymore. And that's where I like these sort of predictable companies in a way. So is the market beating up 15x PE companies next year? I personally don't think so. Very, very slow growth, obviously the bad, right? Very slow. Climbing close to peak, topping the S curve. But like the new products that they launch and moving into digitization 3.0, they might have another inflection point and just sort of raise another S curve, right? But I don't know. This is yet to be seen because these guys are just turtles in growth. But if you like steady, stable income, then Dropbox is the B. And obviously, it's a boring company. Now, what did we talk about? Oh yeah, I want to talk about market share before I forget. Sorry about that. So, there's a competitor which is Box Inc. So I'm trying to figure out like what are the competitors that are sort of apple to apple, right? And I bumped into Box, and I found, so this is the benefit, right? I found that Box basically spends 35%. This is the Q3 of Box. I didn't open up the Q4. But I saw that Box actually spends 35%, and I can work that out again. 218,967 divided by 640,971. 34. They spend 34% on sales marketing of their revenues, right? Dropbox only spends 24. See, that's the difference, right? Operating leverage is seen. They're actually increasing higher quite substantially. So, and their revenue growth is not really that exciting to begin with, right? We got 640 to minus 571, 571. It's like, okay, so it's similar. It's like 12%. But in terms of like, we want to compete in operating leverage, we want to talk about competitors and moats. I would say Dropbox transitioned themselves from cloud storage to, smart workspace, virtual first. They have that edge right now. And so that's number one. The second thing I want to share is that Dropbox actually has an 18.46% market share. It's crazy, right? Software and file sharing. So, big boy like Google Drive is number one, 35%. But Dropbox is beating Microsoft OneDrive. It's insane, right? So think about, adoption in the future. Think about younger adoption. We got your, freelancers, your gig economy, your creative designers, bigger files, right? So we have that in context and qualitative side, we can know that this is bound to grow, right? This is bound to grow. And Boxes is like 3.5% market share. So, and for those of you that are doubting Dropbox in terms of market share, these are some facts for us to see, right? Because 18% is actually crazy. So yeah, guys. So awesome. Hopefully you guys took some value out of this. We looked at Dropbox financials, competition, their 10K, their valuation, right? So again, this is not a buy call. I'm not a financial advisor. Please do your own due diligence. But overall, I hope you guys are hedging your portfolios nicely. Don't panic sell at these times right now. And I'll see you guys next week. Thank you.